Number 2 rule, if I ask a question, somebody has to answer it. Number 3 rule, if I don't like the answer, you get kicked out. Okay? It's after lunch, I have to liven up a bit. Yes, well, you know, you people have been talking about regulations since this morning and my hair's sticking up. Regulation, regulation, regulation. We don't like regulation. We like guidance and good practice. Best practice. So, this is an interesting panel. We've got the last surviving German banker on this panel, Mr. Marco Albers. I don't think there's any other German banker that would even think of coming down to Greece these days. Yeah, they're over here doing what? Other things. But Marco's here working. He's on a panel talking to us. So, of course, we have Captain George Xiradakis, for those of you who don't know. We have Nikos Stratis. He's a quasi-banker. He does do debt, but he charges exorbitant amounts of interest. In the old days, they would call him a Shylock. These days, he's just considered high finance. And then we'll have all of you for the discussion panelists, and I will be waking you up. I think we're going to start off with you, George. Are you going to do a song and dance or a presentation or what? He's actually going to do a presentation.
Good afternoon, ladies and gentlemen. Thank you very much, organizer Yanis and Karen, the Lebanese billionaire. Where is the Lebanese billionaire? You see, I'm saying this because, you know, in our world it's a very, we are living in shipping and we know each other, but they don't know us outside. For instance, yesterday there was someone that told me that, you know, a Greek shipowner passed away 55 years old, and all of us we were looking who it was, the Greek shipowner. So finally we discovered that there was not any shipowner, but he's a Greek that he comes from Sporates, but most probably he has a kaiti or something like that. So, you know, but the outside world, they are saying that he's a shipowner. Likewise, there was a gazette, you know, a newspaper here in Greece that we just opened to see some nice men and nice women, etc. And somehow I saw Kakabi being dressed as an asking Greek guy, and the lesson underneath is the Lebanese billionaire, son of a billionaire that he's celebrating whatever he was celebrating in Mykonos. And then I said to Katerina, my partner, I said, we found the solution of our company. No need to go to China every week, no need to go to US or to Germany, my friend Albert, no need to go. I will call Karen to give me not billions, but just a few millions to pretend that I'm a financier. So finally I discovered that it was a mistake of the journalist. Yeah. Another thing very important to have to tell you is that usually I'm not accepting double invitation from the same organizer of conferences, shipping conferences, the same year. As you remember, last spring, end of spring I was also here when it was May. And I spoke about Chinese financing. Some of you were impressed that you didn't know. Some others didn't care. And then I was thinking about coming here, and Yanis called me and said, George, you must say something. Don't forget that I'm going in, for those fans that you want to follow me, as they're doing with Rolling Stones, etc. I'm on the next one in Amsterdam by the end of this month, Kalomina. So we have a tremendous change in the market, gentlemen. And the market consists of many things, about ships, trade, economy, but people as well. And in our company here, as we are all close, we have a tremendous change on what we are calling people. Haris Vatias got married in the meantime. And I want all of you to congratulate him. It was something like a bomb. It was not easy to be dead digest it, and we are all happy with him. So here, SIP lending, very easy stuff. Google put SIP lending 2012, and what you can find. All these news are that DNB expects 100 billion SIP funding cap as banks curb lending. Financial Times announced that Commerzbank pull out of shipping, and within Commerzbank, all of you dear Greek fellows, you have to remember that is one of the best strategic partner of many Greek ship owners, that was Deutsche Bank. Don't forget this. Commerzbank was a player, but was not a player that was standing next to the Greek ship owner in the bad times and in the old times, because it was not tested up to now. But DSB was a partner, and that is a big loss. Reuters says that bank lending dries up for global shipping industry. Business monitors shipping finance an increasingly rare commodity as lenders sell portfolios. South China, same thing. Lenders hold fire on ailing shipping firms. Bloomberg is saying something nice only, just to create the rule, without an exception there's no rule. ING says it's still worth making ship loans as Eurobank's exit. I haven't seen any loan from ING yet, but welcome. And Maritime says bank retreat on shipping scene filled by private equity, which are all these common things. And somehow in 2008, Xiradakis, I myself, Reuters visited my office and I gave an interview, and I said that the shipping, the crisis will last long. And when I was saying it lasts long, of course I thought that I was somehow in 81, as for those that you remember. But most probably I made a mistake. I was before 81. Because I have to expect that something good is going to happen up to 2016 now. Therefore, I don't know whether, most probably now I'm 82. So, but don't forget that we said that. So where are the facts? What's happening with the shipping financing? It's very easy to my presentation and tell you, sorry guys, there is no financing. There is the issue. In everything and every discussion, shipping discussion that we have, conferences and whatever, we are saying the same thing. We are in a credit crunch, we are in a big crisis. But which are the facts? Banks are pulling out from ship financing, the 4-year long downturn. Bankruptcy filings started, General Maritime, KLC, we have Omega, we have other things, protection, not bankruptcy yet. Ship owners signed with an oversupply of vessels, which is true. Even now, the remaining vessels that they have to come into the market from the orders that we did before 2010, but also in 2010 when some of us we were thinking that the market is going to be better, still we have a lot of millions of tons to come. Slapping freight rates and asset values, we are in the historical levels, whether it is 636 or whether it is 740 or 710, still we are in a very bad market. We have the bunkering fuel oils, the prices which are extremely expensive, and the world economic turmoil continues. Certainly we will discuss this matter. There are people that are much more educated than me, but we can still discuss after that in the panel, because George tell me just give the points in order to commence later. Other facts. As we said, Commerzbank, Société Générale pull out, HSH is another company that has reduced their exposure to the shipping industry, and some of them appear to sell significant portion of their portfolio. We have from all these banks and many others, efforts to sell the portfolios. What is happening, however, is that we did have some announcements from UK banks that they want to sell their portfolios, but if you want to sell your portfolio, you have to determine a nice price. No one is going to come and buy your portfolio at at $1 to the dollar. And I'm afraid that those that they insist in selling their portfolio because they have good clients, because they don't have losses, etc., the only thing that they want is just to pass some time, to keep the momentum if you want, and to keep their job alive, and make the politicians, because most of the banks now are controlled by the politicians, make the politicians believe that this experiment can work, that is to say the experiment of shipping financing, which is healthy from the standpoint of the market players. But on the other side, it doesn't have the opportunities, if you want, those that we expect to get within the crisis. Another fact is that scam financing and the industry slant have forced the restructuring of many shipping firms across the globe, from Norway listing Frontline to Italy's DLMR shipping to Indonesian Berlin luxury tanker and Sanko Simpson and many others. Of course, the Sanko restructuring shocked a lot because we remember very well what was happening in the previous cycle. My friends, I don't know. We remember what was happening. We were crying and we were dancing at the same time, without having any Japanese next to us. Myself, I was a captain at that time. So some more facts and figures. 250 billion is the funding gap left by European banks in shipping market that has to be filled. 65 billion is needed in new debt and equity this year, along to cover orders for new ships and, of course, the sale and purchase market. That is to say, altogether we have 315 billion. Net shipping loan losses at Nordea, the world number 4 shipping lender, tripled to 135 million euros this year, this quarter if I remember well. Loan losses more than to 60 million in Q1 from euros 14 million in Q1 of 2011, year to year. So we have an increase of 34 times of the losses of only this bank. More than half of Commerzbank loan losses provisions of euro 212 million in Q1 2012 were booked in each ship financing unit. From the other side, we have some lenders to the shipping industry. Some of them were banks that they were not in the list at all, the previous years. But they are doing good deals now. MFG, Mizuho Financial Group said that they did something like 1.7 billion. JP Morgan, that if you remember well, pulled out from shipping in the lending side by end of 2000. And by 1999 or something like 2000, they are back there. Bank of America, Citibank, BNP Paribas, they said that they have made some deals. And then we have, again, some Japanese, DNP that is always keen in maintaining its position in the market, Mitsubishi, UFG Financial, and Wells Fargo. Wells Fargo, if you remember, they were not at all in the market the last 10-15 years, and now they are back. So these are signs that some of the older Greek guys that they were in the market, we remember, all of us, that in any crisis, what was happening is that some newcomers were coming, and most of them were coming from the US. Yeah, you agree with me? He's older than me, this is why I'm asking. Yourself, you are not. So, is there any way out? US banks such as Citigroup and Bank of America have become more active. We see that. From the other side, I am the world specialist in the Chinese financing in Greek shipping, and I can assure you that Chinese banks have become a real player. No questions about it. There are some newcomers though from other parts of the world, which is Brazilian bank or banks, Malaysian and Australian. My friend Ted Petropoulos has reported some of them, but some others will be reported in his report ended of 2012. And from the other side we have private equity firms that want to position themselves in the shipping market, but it might be proved difficult to realize the requirement for yields of of up to 15%, they are writing to me in the office. But we see last week that we had another, 10 days ago, that we have another equity package closed for Econom at 6.5%. But of course this does not apply to everyone. But the rule is, however, that they are getting more and more competitive on the equity side. The bond market can feel certainly part of the cap, as here it is noted, this bond, but only few names have access. Shipbuilding countries are ready to inject more money in order to support the industry. I was reading yesterday's Lloyd's list, and they said about this new order of a Chinese company of about, if I remember when Nigel, it was about 40 VL, something like that. Or something like that. So where they get the money? They found the money through their own country, because they have to support us with the industry, but on the other side has to get a leading position in the upturn of the market. So in a sense, this is the environment. There are no money around. Still, however, there are players that they can be of your assistance. They can find some money. This does not mean that you have always to have in your mind that the next package, the next financing that you will do is going to be combined with an opportunistic idea or an opportunistic package. But still, there are going to be players, because at the end of the day, shipping never dies. And certainly, it is very easy to go to Google and search the appropriate guys to make something. And the best thing that to do, I don't want you to say it, but allow me to say this, is that when you Google, you just put XRTC Business Consultants, you go there, you see that we sign loans, etc. You see the nice logo, you see where we are, the office location. It's very easy. We don't pay the taxi to bring you there home, but you still can join us. Thank you very much.
Captain George. Marco, will you entertain us? And I didn't see the name of DekaBank in all the banks that have exited ship finance. There we go. I thought it would be good news, but obviously not.
Not too many news from my side, I'm afraid, today. Well, first of all, good afternoon, ladies and gentlemen. Well, I will also talk a little bit about the question where to raise capital, how much banks will lend going forward, and to whom they will lend. Basically, our bottom line question, will there be sufficient lending capacity for the future, for the order book to come? There might be slight overlap with George's numbers or presentation, so it might be that then I slip through slides a bit quicker in that moment.
What's in the next slide?
Well, the next slide is actually something, that's okay.
It's okay, here you go.
Well, George is pretty kind to me today. I mean, if you have seen him at other events, you can see that bankers might become a bit more popular these days. And also, actually, it's very interesting to see that there are indeed only very few banks present. In former years, half of the audience was actually filled by bankers. Obviously, they either have anything or something else to do at home, or they are just afraid to say what's reality. Anyway, does it work? Okay. Maybe a very brief word on DekaBank, as I believe that not too many of you have had any direct contacts with DekaBank. In the first place, DekaBank is considered to be the central asset manager of the German savings banks group. The savings banks group as such is actually, and that by far the largest banking group in Germany, with around 3.3 trillion of total assets, compared to, for example, 2.2 trillion for Deutsche Bank Group. Maybe it's even, or I guess it's even Europe's largest banking group. Anyway, Deka, as I said, is more considered as a central asset manager So all the liquidity which the savings banks, 430 across Germany, have on their hands on their own balance sheet and through the retail investors are pumped up into DekaBank, and we initiate, we manage open-end funds, retail, indexed stock, fixed income, whatever you want. It's the second largest asset manager in Germany. And I mention that because I will come back on that in a minute on this asset management function. Well, maybe on shipping, what do we do in shipping? We are rather a smaller participant in the shipping market. We have a portfolio of about 2 billion euros. 50% is international, North American, Asia, Middle East, Europe. And the other 50%, I must say, is German. A lot of KG, and that causes some headaches, to be very honest. Current state of the ship finance market. Actually, this slide is 2 years old. I used that at another presentation when I was still with ING in Amsterdam. But in this respect, actually nothing changed for the last 2 years. I mean, there's still pressure by provisioning on defaulted or endangered loans. Risk migration, actually more and more getting the topic, also negative impact on risk-weighted assets for the banks. Well, the poor market outlook, we've talked all day about it. Internal competition for capital, that remains the same, maybe not even offshore. I mean, you can also look like when new opportunities come along, should you do shipping or should you do aviation? And risk committees have actually more favor for other industries rather than shipping. Not only risk committees, actually also the boards in banks. Exit of banks has been mentioned by George. That continues since the last 2 years. So basically, the only new pressure which comes on or has to be added here is actually the Basel III impact. Well, obviously shipping loans are absorbing higher amounts of risk-weighted assets, and therefore banks will be more restrictive to grant new loans and basically to pass on the rising cost for capital to the ship owners. That's comparative data from the last 10 years, the league tables. Here you can actually see on the left-hand side that even though the Bookrunner MLA table, the total syndicated loan volume increased from 2010 to 2011, but it was actually a year of false hope. As you can see on the right-hand table, that the first half 2012 numbers are somewhat more depressive, where you can see that actually the volume declined by some 57% from approximately $35 billion first half 2011 to $15 billion only in first half 2012. So that raises, of course, the question: are there any more banks lending money? Is there capacity going forward, sufficient banks? In this slide, also, not too many changes actually since 2 years. I have a very similar chart prepared 2 years ago. I think the only change I've made is to the French banks. But otherwise, the situation today is pretty much the same. George also mentioned there are a few newcomers, while the US banks, Citi and Bank of America are getting more active. Australian banks, you see more active. Commonwealth Bank, here and there also ANZ. Well, Chinese banks, I have worked with Chinese banks since 2010 or end of 2009. It's some cumbersome work, but at the end, at least they have volume, and they're willing also to step up for larger tickets if the right deal comes Well, Germany also been mentioned. Commerzbank as second largest lender pulled out of ship finance. So that's actually not a good sign into the industry, and also not for us as a German bank. This is more a picture of the German market or the German banks who are in, who are out. Well, Commerzbank and not to forget about UniCredit, HVB, who've been very active in previous years. They actually out of shipping going forward. Then the other category, selective scale back, is HSH, Nord RV, very busy with restructurings, no capacity or manpower for new business. Well, Bremer, you can call it international or regional, at least they have some good exposure here in Greece as well. But they are also very busy with their regional, local restructurings. Then, well, maybe not too much to mention the specialized smaller banks, Swedish, Bernberg, DZ, Hilabar, Warburg. So who's active? That's probably the more important and interesting question. For sure, Deutsche, very active, but you have to have a link somewhere to the capital market to make it interesting for them on a cross-sell basis. KfW, back in the market, they were out for quite a while, then slowly came back into the market on ECA business only, but today, and that's also here in Greece, I've seen them quite busy. LNG, for example, they did some business. And third one is DVB, of course, they are still going strong. Well, DekaBank, as I've mentioned, I mean, we are only a small player in the market, and in this respect, we will not be able, and we don't want to substitute any one of the larger exits. We continue the business on the same level what we've done in the past, and that's it. As we speak about Germany, I wanted to give a brief overview on what's going on in the German market, and in particular in the KG market these days. I mentioned already a lot of restructurings. Restructurings increasing. You have more than 100 KGs already gone bankrupt. You have plenty of equity injections requested from the investors. The number approx 800 KGs are struggling. The restructuring is definitely picking up again, and you also see increasing enforcements. That has many reasons. I mean, that restructurings are picking up. I mean, one is the extending of the longer downturn, obviously. There are plenty of KG projects which are already for 3 years plus in restructuring or in deferral of installments. And that pushes the patience, so to say, of banks and somewhat to the limit. One of the reasons, of course, also is that vessels have been ordered at the wrong time and obviously at the wrong price. I mean, you have in these KGs too many container vessels, but also dry bulk vessels, which have been ordered in 2007, 2008, really at the peak of the peak. 80%, no equity collected at that time, and when they are supposed to leave the yard maybe the last year or still this year, there will be no equity. So either you let go, or the banks usually will have to step in and even have to provide the equity. So you, from one day to another, you have somewhere with decreasing values, you have a loan to value of 200%. That's quite painful. You see a slightly second wave of restructuring files, which is actually coming from the more better KG projects, which have been concluded in maybe 2004, 2005. Still okayish prices, decent medium long-term charter. But these vessels are coming out of a charter around these days, or say within the next 6 to 9 months. And you can imagine that they also not be able to get any break-even charter contracts for the time being. That all leads to risk provisions. That's also George touched on. I made an overview of the four major German shipping banks on their risk provisions for the first half 2012. So that's quite substantial. I mean, you can even, if you look at HSH, for example, if you take the period from first half 2011 to including first half 2012, that's in total 428 million euros of risk provisions. And from Commerzbank, I sort of understood that for the second part of the year, another 200 million will have to be added. So that's not a good outlook for the banks, but also the question here, how to get equity in the projects, in the good ones, or basically also maybe for the distressed ones. This chart shows basically that there's no equity available through the KG market anymore. The KG market, or the KG model, is not really effective anymore. Over all the years, some 32 billion euros of equity has been collected through the system, but as you can see by June 2012, there's only a fraction, and that's probably reclaiming dividends which have been paid out into the KGs. So there's no activity anymore. So someone else has to fill also this gap, and that's also been mentioned. It can be bond markets, private equity. But also a question mark. The next slide, very briefly, only that should only show that the German order book, container ship order book, decreases rapidly due to the fact that more than 20% of the German container vessels have been ordered through the KG model. That's not existing anymore. This order book reduces as well, but maybe for the good, I would say. Well, for the German market as such, it means that KGs or the German shipping companies need some more consolidation. You've seen that, for example, with Air Schifffahrt and Komorowski. I think that's a good joint venture they've put together. You see pools being built with Ahrenkiel and MPC. But bottom line, it is certainly not a patent for successful solutions just to join companies. I mean, two weak companies don't make one strong company. That's also for sure. Bottom line, I would think that a lot of shipping companies in Germany will disappear, probably rather the smaller ones than the larger ones. But well, on the other hand, whether it's Germany or on a global perspective, consolidation is probably much needed anyway. Financing requirements. We put together some numbers, some up-to-date numbers on how we evaluate or how we count the current order book value, which is actually not an order book value, but more the market value of the current order book, which accumulates to $176 billion. And if you would put that on average per annum until 2016, it would need financing, assuming 65% financing, of 23 billion. If you compare that with the numbers below, which I prepared 4 years ago, that's quite a difference. But on the other hand, not all of these order book in 2008 has been realized. Having said that, the 23 billion of the 176 billion of market value order book, while you will have to add, of course, all the refinancings, balloon financings, cruise with an order book of some 15 billion is not included, so there's a little bit more to add. But then, on the other hand, you compare that with the volumes which have been done already in the first half, 2012, I showed you that on, let me see, where is it? This slide. First half of 2012, you had a syndicated loan volume of 15 billion euros. So if you analyze that, it's already 30 billion. So that is more or less in line with the need for the financing here, 23 billion plus refinancing and so on. But that also would assume that shipping banks continue on the same level where they are right now, and that's probably more the question mark that this will not happen. So who will fund further funding gap? That's also been mentioned by George in a way, even though I think that the best solution would still be that orders would be cancelled or would not realize. Wishful thinking. Very important ECA, increasing importance of ECAs for the banks indeed, in particular because many banks are not so much constrained on the business volume but more on the risk capital they have available, and structuring a business with ECA cover that will pretty much help for this bottleneck. Private equity mentioned institutional investors, and here I come to the asset management function of DekaBank. We were already working for quite a while to link our contacts to the institutional investors through our asset management activities, to link that with our credit business. In the previous years, it was not too successful, return was not sufficient, and for some other reasons we could not really get forward. But these days you experience that institutional investors are looking for alternative investments. For example, instead of investing into sovereign Spanish bonds, they might be interested to invest into shipping, aviation, infrastructure. The return expectations have clearly been reduced. Some of them are happy with 3% these days. That's something what a shipping loan can deliver. I have to point out, we're not talking about equity, we're talking about debt. They will invest into a debt position, either by pure sub-participation or through a sort of securitized solution which we would set up through Luxembourg, so that we can fulfill their internal requirements or regulations. That is something which, as I said, we have done or we've developed over the last couple of months. We have concluded first transactions in this respect, but it's a small portion. Again, I mean, it's like when we do a business, restructure a business, we stay in the loan and give, say, 50% to the institutional investors, and even provide them with other service like ratings and so on. And again, the volumes will not be as big, but for us it's a good way of linking asset management with credit. Furthermore, we are right now in the stage to set up a transportation fund where we would place aviation and shipping business, and that to be sold down to the savings banks who also sit on loads of liquidity, don't know where to put it, and there is increasing interest in these solutions as well. That's only a chart where it shows the business segments on the upper left-hand side, the asset management activities, and then on the lower left-hand side, the shipping activities as well. Strategies to secure...
Marco, if you could do it a bit faster.
I'm done, more or less, yeah. Okay, strategies to secure bank financing. Actually, this is also a copy of a slide 2 years back. Well, maybe the main point is maintain banking relationships, be as transparent as possible, and most importantly, avoid surprises. Well, when it's all over, I don't know. The outlook is actually not too good. We already mentioned, especially for the Euroland, we are heading into a recession, so that's not the best sign. Basel III requirements will have a further massive impact on lending availability. Yeah, that would be nice. I don't know what. So anyway, to conclude, it's going to be a tough ride going forward. Only few banks will be really open and willing to look into new business. And if they remain open, then only at the right price, right value, and right name, I guess. Thanks.
Nikos, do you have a presentation or not? You do. Is it long? It depends on what. We'll give you 7. Nikos Stratis, the official title of the day. How much do you charge now for debt? What, 25, 30%? You do it for free. Okay, there you go, guys. There's your funding.
Okay. All right. Let's see. Well, we just focus on the question of if private equity is still interested in shipping. We'll just use a couple of slides to introduce Northern, despite George has been very kind to say a few words about us. So for those who don't know us, we just spend a couple of slides. Then we will look at the industry's performance from a historic perspective, because we like numbers and hopefully substantiate the way we conduct our business. Then we will just say a few facts about the sources of alternative sources of capital for the industry and draw some conclusions. So, Northern is effectively a private ship finance company. And we provide capital to the shipping and offshore space only, so we have an exclusive focus. We have worldwide coverage with offices in the States, London, Norway, Ireland. We have an office in Singapore, but probably the next one will be coming due again. Since the inception, we have raised $500 million of equity. We have financed, the current portfolio stands up to $1.1 billion. We finance vessels across the board, tankers, bulkers, containers, everything. We are now operating under the second vehicle, which we call NSF2, and it has $170 million of equity sitting there, ready to be invested. And we are officially open for business and realistically looking for investments. And the way we deploy the capital is in the form of sale and leasebacks, bridge facilities, mezzanine participations, and pure equity investments. In terms of background and where we're coming from, we have been operating effectively under the same business model since the late 90s. We have an extensive experience both in terms of management and sponsors, cumulatively more than 200 years. We have financed more than 170 vessels. You can see a graph representing the breakdown of the portfolio of the different assets we have financed. Within there is probably more specialized assets. For example, the dry could include cement, the tankers could include chemical tankers, asphalt carriers, and what have you. So we're not newcomers trying to get the benefit of the industry as it develops, as some others are effectively coming into the game right now. So this is a quick overview about who we are. Now, in order to set the context for the industry's performance, which is the next point in the agenda, from a historic perspective, throughout the cycles, and trying to get a feel, and I say just a feel, of the duration and magnitudes of the industry's upturns and downturns, we have performed this analysis. And effectively, we just took an index, and there was a lot of discussion about indices this morning, but we just used a ready-made index without influencing the data or whatever, and this is the Clark-C index, which represents in dollars per day the freight earnings of the world global fleet. So the blue line effectively has, we have plotted the 1-year moving average just to remove the market noise of that data from 1990 to up to today. And under the blue line we have highlighted with red shading the downturns of the industry, and with green, the upturns of the industry. So, if you look at the tabulated data effectively at the bottom of the slide, you can see that the average duration of the downturns is similar or almost identical to the average duration, in terms of freight always, of the upturns. But the magnitude change of the downturns is 2 times less, or put it the other way, the upturn magnitude change is twice that of the downturns. Now we did the same analysis using the second-hand vessel price index. Again, this is the dollar per deadweight price index from Clarksons for the world, the global fleet from 86 up to today. Same exercise, 1 year moving average with the blue line, green sections indicate the upturns, red sections the downturns. Here what you see is the average duration of downturns is almost 20 months, but the average duration of upturns is almost 32 months. And again, the magnitude in terms of asset gains is significantly substantially more than the magnitude of the downturns. So, of course, this analysis is just giving us a feel from a historic perspective, because at the end of the day, we're not here to sell you our story. We are trying to make educated investments and guesstimates on the way we deploy our capital in a very cyclical and risky industry. So, the premise of this analysis assumes perfect timing. So, it assumes that somebody enters either at the bottom of the cycle and exits at the top, or he enters at the top and exits at the very bottom if you're looking at the downturn. Of course, this cannot be achieved, or it can be achieved only occasionally if you are extremely lucky or unlucky. So we have actually sensitized these data and performed exactly the same analysis, assuming that the investor missed the timing by 50%. So he actually came in either halfway during the upturn and exited halfway during the downturn, or he entered the investment halfway in the downturn and exited halfway in the upturn. And then you have the data here again in a tabulated form. The top table, you see the results from the Clarksons index, where effectively the average duration, if you enter halfway on the way up and halfway on the way down, is almost again identical to the entry and exit halfway down and halfway up. In terms of magnitude, from freight perspective, if somebody participates only on the freight, you almost broke even, minus 2%, if you enter halfway up and exit halfway down, but you had a positive result of 8% if you entered halfway down and exited on the way up. Now, in terms of second-hand vessel prices, the magnitudes you can see, 27 and 22, 23%. But what is interesting to know, in both cases, the magnitude change in terms of asset gain is actually positive. So this result, or this quick analysis, effectively indicates that provided you take a long-term view towards shipping investments, you're more likely to make money as opposed to lose money, even if your timing is not perfect. At present, the right-hand side of the table is probably the more relevant, since we are in a correcting market. So for those that think that the industry has already gone, from a global fleet perspective, has gone beyond a 50% correction, then it's actually a very attractive time to invest. Now, of course, an investment today, the success of that investment will depend on two things in our thinking anyway. The availability of adequate capital to sustain the duration of the downturn, and the return expectation of the investment thesis. So, return expectation both in terms of yield and IRR. So buying cheap can become expensive, and indeed can become very expensive if you're not buying or not investing in the right type of vessel. So if the premise of your investment is just to buy cheap and expect to exit in 5 or 7 years' time at the levels of freight and valuations that we experienced in 2007 and 2008, then most likely people will be disappointed. Investing in shipping, as far as we are concerned, is not just about buying low and selling high. So from The analysis so far is looking at the global fleet and effectively investing in a basket of vessels that replicate the global fleet. But if we focus in a little bit more into a specific sub-segment and we look at the Panamax dry bulk carrier, we have plotted the PPP index. PPP is not the purchasing power parity theory that many who have studied economics might know, but is what we call the Panamax purchasing power index. This effectively represents how many Panamax, 10-year-old Panamax vessels, $100 million would have bought you at this point in the cycle, starting from 81 all the way up to today. And we have applied an inflation adjustment on the 100 million of 81 up to today of 3.3%, so that we maintain the same purchasing power effectively. So as you can see, in 86, $100 million would have bought you more than 30 Panamaxes, 10-year-old. And in 2007, 2008, they could have bought you 4 Panamaxes. So the underlying factor, of course, for this fluctuation relates to the expectations that the investors place in relation to the asset. So if you now plot the freight earnings, 12-month time charter earnings, of the same vessel for the same period, 81 to 2012, you can see that today, $100 million, inflation adjusted, can actually buy you the same number of Panamax vessels that could buy you in 2001. And the freight earnings, at the bottom graph, represent a similar scenario. But if you take into account the size of the current dry bulk fleet, the age profile of the fleet, the ample shipbuilding capacity, and the faltering economies, and the vessels that have yet to be delivered, and for this, although it was mentioned this morning with a few presentations, the order book, I would say there is, again according to statistics, 283 Capes to be delivered, 711 Panamax, post-Panamax, Kamsamaxes, 488 Supramaxes, and 445 handy vessels, which is, of course, a huge number of vessels. I'm afraid it's only reasonable to assume that the PPP index can go up over what could be a prolonged low freight market environment, so effectively hovering about the same earnings for some time yet to come. So, back to the main question, is private equity still interested in shipping? And the answer is yes, and in fact it is more than ever. And the reasons for that is you have, of course, the market cyclicality value correction that we explained in the previous graphs, but further, you have downward pressure due to unavailability of capital and faltering of banks that Albers, of course, explained very well. So you have deep value investment opportunities. And then again, you have distress situations. Again, we show some examples of the cases, but it's not the only, and some others mentioned earlier today. And it is the second and third that create the largest interest to private equity investors to come into the industry. It is the distress and it is the deep value investment opportunities. Then, of course, you have regulatory changes and technical innovations, and we have innovations, we mean fuel efficient designs and all these concepts that are coming in, but we have them in quotes because I think the most recent innovation in shipping happened probably 20 years ago. It is just now that people decided to pay attention to it and apply what is already known in order to achieve the efficiencies that can be extracted. And then you have industry consolidation, of course, and the efficiencies that can be derived from that. So, yes, they are interested, but then it's important to distinguish between the type of alternative capital providers. There are broadly two main categories. The first one is opportunistic distress investors that are aiming 25-30% return on their money or multiple returns on their capital. Then you have private equity ship financing companies like Northern. We are aiming for a long-term risk-adjusted industry-supported return. And maybe third category could be the arrangers market, which are representing ad hoc capital that has interest in shipping in exchange for a fee. The opportunistic private equity may at first have limited understanding about the industry, but it can acquire knowledge, it can learn very fast, and it can link up with industry expertise. They categorize shipping as a special asset class of high risk. And for their participation, they want full upside. They need time to find the right partner and the structure to participate under. Once they do, they can allocate substantial amounts of money, but they require proper governance, decision-making, control, and others. And of course, they have experience in handling distress situations from other participations in different industries. Private ship finance companies participate usually complementary to debt, if there is any. They would like to see some commitment from the owners or the sponsor of the project. They have good understanding about the industry and industry links, do not require control beyond the financed assets, and can operate under predetermined and upfront agreed pricing. So what can the alternative capital providers offer? First of all, they can offer large capital injections day one. The bank today, if you find one, they can probably give you 60-65%, and that's about it. Private equity, if it decides to come in, it will come in with much higher advance ratios, if you want to call them, together for that investment. They can offer longer investment horizons at no impact on the cost of funding. If you go to the bank and you take 5-year money, it will cost you LIBOR plus something. If you go 7, 8, 9-year money, it will cost you much more. Liquidity cost of banks is significantly higher. If the bank is based in euros, access to dollar is an issue, etc. So that issue doesn't apply as far as private equity is concerned. Private equity or alternative sources of capital can accept minimum or zero running yield. They can effectively structure their returns on the basis of an expected market recovery, and that's how they can achieve their money. If the yield, even if minimal, is there, fine. If not, the market-based view can be taken. They can take residual value positions and can wait until redemption, can wait until the exit for the redemption of the capital, contrary again to the bank, where you have to have amortization of principal over what now is the norm, very short profiles. So the first few factors we just described effectively translate into shipping investments with sustainable break-evens. So if you're investing in Panamax tonnages, you could have break-evens that are even supported today, even if you include a small yield for the private equity investor, that's supported still even under today's freight markets. Then you have other reasons. They can accommodate transaction sizes smaller than other markets would accommodate. They can introduce new banks, can consider most types of shipping assets, and can introduce corporate governance to smaller companies. But of course, you could ask if they are if they can offer so much, why haven't they not developed any further or more before now? I think part of the problem lies with the banks. I mean, the banks have consistently offered high advance ratio at very low pricing, which has failed to reflect the underlying risk of their capital injection. This effectively kept away the private equity, which is a little bit smarter capital if you want, and they never accepted to take any incremental risk for the inappropriate remuneration. Alternative sources of capital exist and are widely available in many other capital-intensive industries. At the same time, ship owners were accustomed to a very easy and cheap funding mechanism while keeping full control, upside, and they never had to share or give anything away, so the industry just kept going on in the same way.
Nico, can you speed it up a bit so we can have some questions? Thank you.
Okay. But having said that, the landscape is changing. The small and medium-sized owners will find it increasingly hard to attract traditional bank debt, not because of lack of their qualities, but because of the drastic changes into the banking scene. So, for those that are interested to explore the alternative sources of capital, what are the requirements? Here is a list. Alignment of interest is very important. Enterprise value creation, separation of asset management, of asset holding company and management company, which has been the norm and widely accepted, is not longer or is not viable for private equity investments. They want decision making and control, especially if it's a private equity investor. If it's a private finance company, it is not really an issue. Competent management track record and reputation is key. They need to know who they're going to bet with. I cannot emphasize how important that is. Exit strategy is important. It doesn't matter if you change the exit strategy as the markets develop and you are in the investment, but something has to be there from the outset. And some furthermore liquid assets in terms of S&P, so you can exit the investment. So, concluding remarks. We have, of course, so far maybe in this presentation criticized the banks a little bit, but banks have to come back in the long run, and they will. Private equity and owners rely on shipping banks in the long run, but when the banks come back, they will be under a different mandate, and industry consolidation will be actually forced in a way. Owners that want to access the current opportunity as properly developed, they should keep an open mind toward alternative capital providers, and pricing alone should not be the single deciding factor when you're selecting your capital provider. I know a number of cases where people have accepted cheap financing from a bank at LIBOR +2, while indirectly giving away the full control of the company to the bankers via the terms and conditions and covenants and restrictive covenants under the loan agreement. So from a private equity perspective, is a viable alternative. More than enough business model exists to cater for different requirements of the ship owners want. The requirements of the alternative capital are not crazy, as you have seen, and we have been operating under the model since the late 90s. It's just up to you to find the right partner. And on a legal remark, we just never told you what we just said. Thank you.
So, will the beautiful Danai Christina come up? First of all, can we have a round of applause for the ladies, because they've been all day here. Run around the microphone. Nobody has said thank you to them. So we have a number of themes that come up over here. There's not enough money out there. The banks don't have money. They have to come back. DekaBank may have money, but they've got to figure out their German mess first. George Xiradakis will bring us money from China as long as you build in China and you charter to a Chinese charterer. Nikos Stratis will give alternative finance, but he wants all sorts of bells and whistles attached, which is probably right. And I'd like to see if there are any questions. If not, I'll start asking questions. So it'd be easier if you have questions, much lighter than me asking you. Dimitri, please.
Question. The 15% return on investment that would sort of be the threshold, how is that calculated? On what exit basis, and what kind of criteria for market improvement and exit is envisaged in that?
Yeah, I mean, the return is usually made up of two factors. One is the running yield, if any, and then is the residual value position that one has to assume to enhance his position. The way we do it, at least, is we examine historic statistics and asset value developments for the specific sectors and sub-sectors. Look at the order book, the age profile of the fleet, trade patterns, world economy. So I don't think very different to what a ship owner would actually do. I don't know if that answers your question.
Well, the ship owner doesn't always imagine the 15% return. He imagines what is the downside and takes a view of how much better it can get. Doesn't usually calculate the specific rate of return. I think that's the difference. You look at more at the downside. How much will I lose if I do this?
Yeah. Downside is very important for us as well. We evaluate the same. But yeah, we have to make certain assumptions. I think the best guesstimate is looking at historic and statistics. And sometimes you make it, sometimes you don't. But yeah, our preference is also not to lose money along the way.
Maurizio, you're an Italian ship owner. Do you share the views that are being discussed over here? Do you find it difficult to find finance? Are there any banks in Italy providing finance? Is there private equity in Italian ship owners?
Of course the banks are very concerned, but surprisingly they are the one who still approach you and are ready to you can say, to navigate together with you on specific project, not on sort of they really would like to share with you a vision. And then they listen, and then there is a very good relationship in these cases.
These are Italian banks?
Yeah.
Unfortunately, I don't think we have Greek banks like that today. Mr. Ratsos, you have a...
Another question.
Can one of the young ladies, Christina?
I just wanted to congratulate Nikos Stratis on an excellent analysis. I've just finished, George.
Oh, you did? But she can still sit there.
All I wanted to do is congratulate Nikos Stratis on an excellent analysis. I haven't seen such a good analysis on shipping for a long time.
There you go. Mr. Budura, welcome.
Thank you, and sorry for my delay.
How was your lunch? It must have been better than ours, because you took your time. You were not here for the presentations, but I'll sum it up for you. There is, of course, that's fine. Funding gap, there's no money, no banks. Private equity is looking at it, but not sure yet. China may be looking at it under certain circumstances. What are you doing these days? Are you finding any money out there?
Well, I'm talking to George Xiradakis for starters, but I'm not getting anywhere.
Captain George?
No comment because I am an insider, and if I say something, I might destroy the situation.
No, but seriously, it is hard. I'm afraid of saying something, or rather many things that you've heard before, because I was good enough to read the previous speakers. It's tough, but money is out there. There is money out there. And there is even money in the capital markets. There's money in the bond market. Private equity is also very difficult. I think maybe the most difficult of all is private equity, because usually you indulge into very long discussions, and in most cases, maybe more than 9 out of 10, nothing materializes. And conventional debt is still there, but it's less of it, less clients, less money, more expensive.
Thank you, guys. Leonida Polemis, what do you think? We've been reading about things that you might be doing in the newspapers over the past few months. Do you have an opinion about where you're going to find money to do your investments?
Well, thank you for doing this, both.
You're most welcome.
As Mr. said, there is money out there, and you can find it with private equity, but you really have to give up on the upside if that's what you're looking for. We're also looking for really, if you're looking, Nikos is, I think, aware, because they come from a shipping background, I think, the investors, so they understand that they can be patient in shipping. But usually most private equity are looking for yield, therefore in this market is not possible. That's the usual situation. But what we're trying to do is a bit different, and we've seen it before. You might be able to raise money in that situation, which is called the SPAC, and we'll see in a couple of weeks what happens.
There you go. Well, good luck on that. Before you, Fabrizio, I want to ask Alex Tomaso, sitting beside you, who represents Wärtsilä. Do you think we're going to go back to the days where there will be vendor finance from engine manufacturers and others direct to the owner, not to the yards? Days when you would go to a yard and the yard would give you vendor finance on the hull, and then you would go to Wärtsilä and you get vendor finance on the main engine, and then you would go to somebody else and get vendor finance on the auxiliary engine generators. Do you see that coming with the reality of lack of finance?
Even on that days that you're referring, it didn't happen so often. It was very seldom the cases. And usually there was an ECA involved, export credit agency. And there might be certain cases like this, but I don't believe it's very common to happen.
Fabrizio, you wanted to say something?
Yes, I want to state my view about private equity. Coming back to the Nikos presentation, it was very clear, very bright. So Nikos, we make the same work, and also Hugo is a good witness of a private equity approach, because it's not important the 15 or 12 or 16%, but it's not comparable private equity with traditional banks. But I want to state 2 points, 2 topics. So the private equity market is strictly connected to the debt market, because, as you know, we use the leverage when we back the investments. So, and the almost drive debt market affect also private equity. 1. 2. We raise money also among financial institutions and among the banks. Actually, the attitude of the banks is pretty negative to invest in private equity funds due to the very tough requirements for Basel III new rules. So, by the way, I think that one of the main important issues for private equity dedicated to the shipping is the specialization and the size. Larger size in order to inject more equity in the project. And I think that nowadays, currently, private equity for the banks is less risky than the shipowners or some shipowners. And the second point is the specialization. Because I am seeing, I don't know if Nikos shares my view, but too much project were splashed in the market now for private equity. If you go and if you walk around the Hyde Park, you see a man or a guy on the podium that raises money for shipping. And specialization and the track record and the experience of the team is one of the crucial points, in my view. I would like to get the opinion of the speakers.
Yes, yeah, of course, yeah, I fully agree. I think one of the points on one of the slides was that the track record, reputation and expertise of both the ship owners, if the private equity is looking to do business with the ship owner, but the private equity company which is looking to attract capital is absolutely key. And further, continuity and succession of the business model is equally important. And so, fully agree with what you say. And size does matter, especially in shipping, which is an extremely capital-intensive industry. And if there is actually a point where private equity in fact competes with bank debt today, is on the ability, for those who can, to underwrite larger amounts of money than what banks would provide, because they take a different view on the risk side. And pricing, as I said before, should not be the deciding factor. If you think the opportunity is there and you're scared of sharing part of the upside with a private ship finance company, you are actually, and you don't participate in the opportunity, you miss the opportunity altogether. But you can extend your piece of participation by joining up with the private equity. Maybe you have 100 million of equity of your own. Join up with the private ship finance company, make that 150, 100 or 200 if you believe in the opportunity. And then your upside, yes, you have to share for it, but you don't give anything for free. The private equity invested capital, maybe more than what you did in the venture, and they should get remunerated as well. But then you're both on the same boat.
In fact, I think that the private equity, I believe that private equity is not the alternative to the debt. It's the right combination with the debt.
If the marriage or the marriage of two entities that they share the same
is a marriage
from the risk.
George, is a marriage, not a sexy tie.
Yeah, correct. But you can do both, Fabrizio. So the question, Mr. Xiradakis, you will get the microphone in a minute. From Mr. Xiradakis, you Xiradakis, I have a microphone. Before you start, what I would like to ask you, Nico, is how important is it today for private equity to be able to lever up? Because in order to meet the return hurdles that you have, that you've mentioned, 15%, earlier today we heard 20, 25, and we've all talked to private equity providers, and you do find people that range anywhere from 10 to 30%, depending on their MOs. But in order to achieve these types of returns, you need leverage in today's market. And debt is not available, period. It's not available for anybody. It doesn't matter how blue chip you are, how big, how this, how the other. Debt is not available for other reasons. How do you make up for this, Nico? How does private equity look at this?
Yeah, I mean, the main opportunity comes from the deep distress situation and buying entry points. So if you invest in shipping and you have the ability to underwrite the transaction 100% for cash, your return will be, of course, very low. But then you have to take certain assumptions on the banks coming back, and as we said before, we need the banks to come back, and we do think the banks will come back under a different mandate. So you have to position yourself to be able to access the bank capital when the banks come back. And then the second one would be through the recovery of the markets, which will also happen. The question, the tricky point is when and what assumptions do you make about when the market will come back, and how do you position yourself to access the bank credit when it becomes available? If you do those two things, your return actually would exceed your initial expectations, from the perspective that you have two parameters to play as opposed to one.
Mr. Xiradakis, you have a comment or a question?
Yes, I wanted to ask the last two speakers. I watched with great interest when they're using this cyclical analysis and trying to get to see where you're on the downwards dip that we are at now, and when is a good time to get in. But isn't this cycle different from the previous ones in that there are exterior factors, such as exterior factors that are going to be weighing on the vessels, such as scrubbers, ballast treatment, NOx treatment, greater efficiency requirements for CO2 minimization, which could easily drive you up $10 million. And this is, as the price of the ship's going down, this is becoming a greater and greater percentage of the actual value of the ship, which could very easily drive it over the edge and make it non-profitable. How are you accounting for this particular idiosyncrasy of this particular dip cycle?
As a banker, to respond to that and see how because they are businessmen, so they should be able to take risks. I want to know how a bank takes a look at it, and I would also like Marco to let us to discuss the possibility or his thoughts about DekaBank providing debt or finance to a private equity structure.
Well, to answer the first question, probably don't have a look at it at all. Or say we haven't done it in the past. Of course, you see these days that everything you order from now on has a competitive advantage, not only in price, but also in particular by design, fuel efficiency, and so on. And that is something you have to take into consideration if you look at new projects. But we don't have a model or any such that we can really value that. Something, common sense, and then you take your view on it. What was the second question again?
We're talking about private equity here and how it's filling in or could be filling in for part of the funding gap. There is a lack of debt, though. Private equity, when it goes along the ship owner, it needs debt as well. Is this something that DekaBank would look at? How do you view these things?
Yes, we look at it actually from two different perspectives. I mean, on one hand, we also have institutional investors who are not only interested to invest on the debt side, but also on the equity side. So that's it's rare, but you here and there have this approach, and that for us would be even the perfect link and perfect match to bring things together. Generally speaking, we would not prefer a business where you only have external equity coming into a project. Actually, we would like to see the ship owner or the initiator to take a substantial part in the equity portion. We want to see and we want to know that the ship owner, the buyer, is involved in the project, some hurt money, so to say, and we would not do any new project where equity would only be sourced from external sources.
Do we have any questions? You have something to say, Captain George. Mr. Tomasos first and Mr. Trifilis right behind me.
At Mr. Stratis' presentation, we noticed here with Mr. Su, which was very interesting, that when you were referring to the 100 million purchasing power for Panamax, for September 2012, you mentioned 18 vessels. Is it with today market prices or for a 10 years old Panamax? Which it doesn't make exactly the math. I'm saying this because everybody in the shipping industry is trying, as we know, to find which is the optimum timing and comparing with the previous years and the crisis of 1980s. And I was noticing, by the way, that September 2012, your analysis matches with 82 and not 86. If you were pulling the line in the overhead. So theoretically now we have the same price level, inflation adjusted with 1982. And I had also another question to Mr. Albers, if it's possible, you mentioned for some billions of provisions that HSH had made and all of the banks, the German banks, let's say 400 or 500 billion for the first half 2012, something like that. I'm more curious, what is your opinion? Are these provisions really adjusted to the market prices, or they are, how fair they are, let's say? For example, the Greek bank, they have not exactly adjusted to the fair values in relation to the Greek values in whatever industries, marine or onshore or whatever. But what's the case? What is your opinion about the way that the German banks have made the provisions?
Well, I cannot really speak on behalf of every other bank, as I don't know in very much detail how they came to the provisions they have booked at the end of the day. It was in millions, by the way, not billions. I mean, not to get the wrong message. Usually by regulations, you would have to follow the IFRS cash flow approach. And that's, for example, also how we have done it in the past with Deka. Actually, when you want to take it from a more practical approach, you simply look on the current values and say what do I actually have on stake when the project goes bust. And that's actually how I would prefer to look into provisioning these days. Sure, I mean, you have to comply with accounting standards, and we'll have to go into discussions with your auditors. But again, it's a practical approach, and I believe that's the safest anyway. For the other banks, again, I don't know in detail. I mean, when the crisis really started in 08, 09, there were saying that, for example, that one or two leading banks were doing just a percentage approach. They said, okay, let's provision percentage X over the whole portfolio, and then let's see how we get through it. I don't know how they have made a deal with their auditors, but now they have to fine-tune anyway.
Nico, do you want to quickly respond to what
Yes, the first point, yes, it is based on today's valuation of Panamax vessels, for 10-year-old vessels. Of course, if you apply a 3% or 3 point something, whatever it was, inflation factor on 100 million in 81, it translates to something like $270 million in today's money. So, sorry, the?
No, the 270.
No, it's 270. 100 million was in 81, but it translates to 270 in today's terms. No?
Yanni Trifilis?
Okay, thanks, George. Basically, I just wanted to ask Marco and maybe Nico can also have a view on this. Earlier we saw an interesting slide by George Gratsos which showed that there is not so much security in long-term charters. They kind of tend to cap the upside but they do not represent a guarantee on the downside. This was interesting because it was statistically sort of plotted. It's something all of us have experienced in the last 5 or 3 years anyway, for sure. Something a lot of us maybe thought was anyway the situation. And Marco, interestingly, when he referred to what went wrong with the KG system, he said basically they bought at the wrong time. He did not refer to the wrong model or the lack of charter cover or the wrong type of vessel or anything, just the timing. And the timing was again very much at the center of Nikos' presentation. So I'm wondering, since most of the people seem to agree today that timing is probably more important than any kind of charter cover, and that anyway the future is more or less not that determinable, why do banks continue to maintain this false blanket of security and this psychological obsession with everything coming with something attached that will just kill any upside you get? So, thanks.
Marco, be my guest.
Well, I fully agree that you can put a doubt on long-term charters as really solid security. I think this is also for us a lesson learned in previous days, so to say. You thought, well, the KG project was a 10-year long-term charter to Sanko, for example, is rock solid, yeah? Well, you know what that means today if you have such a vessel in your portfolio on a KG basis. This is lesson learned. Timing, well, it was booming time. I think every banker knew that this would have to come to an end, but there was simply too much liquidity within the bank. They had to throw it after every project. German banks even went for KG projects which were ordered without any employment. At the end it was a gamble, and then again you could see that this will not pay off in the long run, and lesson learned.
It's not about the past, the question is more why do you keep sticking to this model?
Well, let's say you change priorities where you look at. There are only few banks which would go into pure project related financing, but in the first place they look at the corporate behind the project. So are there sufficient cash flows within the company, also from other assets which could support the particular financing you are looking at? The charter will only be a second priority in this respect. Why do you need it? Well, it makes risk people happy, probably.
I think I have Mr. Philip Berikos and then Mr. Dimitris Liras. Philip.
Well, I will start with a joke. You know the joke about the bankers, that sort of he lands you an umbrella when the weather is good, and he takes it when it's raining. Well, today it's raining, so you have the umbrella, we don't have it. So I think that kind of sums it. But I think what I wanted to say really is very much what Dean Zeratopoulos was asking, and it has not been answered. I think it is a very serious question today. First of all, I mean, when is going to be the recovery, which is a big question, and if there is a slow recovery because there's excess shipbuilding capacity, we're talking a long time, then the ship's life is going to be reduced in the eyes of charters, government, security, whatever. So by buying a 10-year-old ship, you're taking a hell of a big risk, which you may never recover. And especially when you have these impending expenses, which will be environmental. In the case of all ships, you have a market-based mechanism, possibly. You will have the ballast water thing, which God knows how much it's going to cost. And you will have the choice between the scrubbers, which probably won't fit in your ship and will be very expensive, or having to pay very expensive bunkers. So you'll be competing against eco ships, which will already be backfitted at least with some ballast water system. It's a very, very difficult equation. So I really think that when you come to it, you really have to try to decide whether you buy or resell today at a very cheap price, or you invest into a new ship. I think that's really the equation.
I expect, Philip, that you're not expecting an answer on that, right?
No, there is an answer.
Well, no, I think
there are many answers.
No, of course there are many answers, but I mean,
Philip, I'm with you. I mean, actually, this is what we are discussing here. How to raise money, whether we can be able to raise money. And at the end of the day, I try to irritate you and have some questions, have some discussion about the topic. And we usually speak now about the equity. Of course it is very important, the equity, but it is not the main source now here, because most of these guys, and at least those that they want to invest in shipping, they do have equity. And I don't know whether they are ready to take or to follow you on the 15% return on equity, when at the same time, when they have money, they don't know where to place them, because even if they put it in a European bank or in a US bank, they might lose the money. So for them, for the ship owners, the only thing that they know is how to run ships and how to go up and down the waves of the cycles. So here, let's discuss it. We all agree that there are some players. We all say that we don't know when exactly, I don't remember your name, Your Excellency, what is Mr. Xiradakis? Δεν θα θυμάμαι το μεγάλο όνομα έσκησε, το μικρόφωνο με τσίνη. So the thing is, first of all, let's put it, I'm not gracious myself that I have finished MIT, but I'm a pure captain on a boat that I used to be in the 80s, and I suffered with the crisis. What I know, and I'm starting from there, is that we are in a new world. We are not even in the globalized world on the phase 1 as we knew it up to 2008. We are in the phase 2 of globalization. We are in another pattern of trade with people and millions of people, hundreds of millions of people, that they are not only developing, but they are demanding a better standard of living. I'm calling about Brazil, I'm calling about Indonesia, I'm calling about Africa in general with all these new investments that are being made. And I'm calling, of course, about China and about India, which is, the BRIC, as we were saying. So this is the new environment. Then we have another issue. When you approach a bank now, allow me to say that you cannot go and ask 80% in order, by explaining to them that, listen guys, here we are in the low market, the prices are in historical low, and this is the opportunity for all of you to make money. What all of you to make money? How you can say this to the banker? Because the banker has not made money in the other side of the cycle. We were fighting, the bankers, that we were all at that time stupid, that we were giving money to everybody, if you remember well. We were fighting to get the deal for 5 basis points or for 4 basis points. And the margins at those times, I'm talking, if you want an example, for the AAA names, even of the Greek market, they were even below 50 basis points. And we were losing the opportunity. So all these loans created the losses. Apart of the fact of the shipping cycle, I'm telling you about the cost of funding. Did you remember what happened in October 2010? There was not any reason for any European bank to be involved in any financing with US currency. There was not any reason. All of them were lost. So the best thing, the best thing that you must do when you want to get your money is first of all to go to your banks that you were standing with them the last years. You grew up together with them. This bank, even they might find some money.
But they're not there, George.
Listen, they are not there, the half of them, but the other half are there. is what we are telling. Don't get a miserable position. All right? Find out what you ask from the bank. You cannot go there to the bank and ask 80%, let's say 90%, because your mind is logical. Of course I agree with Yannis, and I agree with everybody, that now it is better to finance 100%, even 120%. Myself, I finance, and there are testimonies, even John Chilas can tell you this, I financed at those times in the Asian crisis, containers of 100%. But it happened because at that time the bank had the money. Now, even if the same bank was alive at present, they would have the money to give. But you go there and you ask for less money. Even a 40% financing is a better contribution to your capital than the 15% cost of capital that is giving you from the private company. So at the same time, yes, we are saying, I'm telling you another thing, what is happening and what we are discussing, not in Piraeus, because Piraeus, it's all over the world, because we are running all over the world. They say, for instance, the Chinese financing is very expensive, blah, 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 blah. What's very expensive? Your problem is the 20 basis points, and we are discussing here about alternative sources of capital that only the fees, I'm not talking about the private, I'm talking about the capital market. Only the fee stands at 7%. Is there any difference on the 30 basis points or the 20 basis points in the long run between a potential European financing with the Chinese financing? So therefore, this is why I'm saying it is narrow. We have to be pragmatic. We have to, personally, in order to ask the question of Philip and of Yannis, I don't know when the market will go up. I don't know. I failed once. I said in 2008 it's going to be long. And I feel that even now, as I told you in my presentation, that I am in 81. Meaning, at least I give another 4 years for the recovery. I wish I failed. And I will celebrate with you in another conference next year or 2 years later if it will recover. But the way that it is, with what I'm expecting to be in the market, and at the same time the readiness of the yards to build up ships and of Tomasos to provide engines, this shows me that whatever is going to be the inflation, the upturn trend, is going to be killed in a few months. So, certainly, my suggestion as a banker is that speak with your own bankers, they might find some money. This is not alright. They cannot do many more business. It's very difficult to find new business for a newcomer. For instance, there are newcomers here in the market, alright, that they want to raise money. It is very difficult. They have to understand that they have to put more equity. And sometimes to use all their equity. What was happening in the 80s and in the 90s? There were the newcomers, some of them, there are a lot of them here, that they were putting 50-60% of equity and they were getting their first loan at 40%. So, yes, there is a scarcity, but we didn't have every time in our mind all these huge new buildings, and not all of us we are in the new buildings. For the new buildings we have solved the issue. At least from China. From other parts of the world, they have as well. Exim has to support as well their industry. As they are happening with the specialized market, in the offshore market. What is happening? The ECAs are working very perfectly. They are putting in the guarantees. So this is my view, and of course I welcome equity providers. You know why I welcome you? Because I don't have equity myself.
There you go. I want to make just one point. We should be very careful. Private equity is not a replacement of bank debt. Yeah? Fabrizio said that, I said that in my presentation, and I have to say it again. We're not saying that private equity, private finance companies or whatever are here to replace bank debt. Yeah? We must be absolutely clear about that. You're saying that the low market could last for some time. We agree, we believe the same. You're saying that equity injections have to be higher and advance from the banks will be lower. We also agree there. It is because of that you need the private equity, because not only you have to put larger capital injections down, you have to preserve liquidity to sustain the downturn at the same time. So
This is the main principle of financing.
Joining forces.
Yeah.
So joining
This is the main
forces.
principle. You don't invest in shipping without having working capital. I'm not going to the theory, I'm going to the practice.
Dimitri Liras, did you want to say something?
No, I think the discussion
You've been covered.
Yes.
Do we have any questions? Hold on, Clay. Karen is an organizer. He gets preference over you.
I'm sorry.
No, Karen, please.
Basically, I just wanted to say it's about China and it's about what we're talking about, scrubbers and vendor financing and this and that. Chinese government, I was there last week, and they made a huge announcement that they're going to be investing a new stimulus program to fuel green projects within China. And the number was 17 trillion yuan. That is 2.68 trillion US dollars. That's a big number.
That is a big number. By the way, talking about vendor finance, will you do that with the scrubbers?
I'll try.
Because otherwise I don't see anybody else financing us to put scrubbers in our vessels. Definitely banks won't. I know that none of us have equity on the side or extra money or working capital. We're all drained.
George,
Seriously.
George, listen to me. This is another problem. It's not shipping financing.
It's not shipping financing, but it's the same
banks
problem.
might discover to put it on the energy side.
I don't care where they put it. It's not complicated. We have complicated our lives because we're sitting here and we've talked since the morning about regulation. A bit more regulation is going to come out of my ears in the end. Greeks over here have an issue with regulation. Greek ship owners have a big issue with regulation because they have been very successfully self-regulated for at least 3 generations. And suddenly, we're sitting here and saying that as an industry, we cannot self-regulate, we cannot guide ourselves, we don't know how to follow best principles, so we need somebody outside who has no clue what he's talking about to tell us how to regulate ourselves, whether it's SOx, NOx, scrubbers, or anything else.
It's not.
This is just so you know how I feel. No.
I'm a nationalist, even myself, but don't forget that here, the Greek supporter and myself, all of us, we are not working in Greece. We're working globally, we have to respect.
True.
But thank you. But we have people like...
I will on a case-by-case basis. And one last thing I wanted to say is, because we're all asking when are the banks going to start financing, when are they going to give money, when are they going to go back to business? Well, I would like to invite each and every one of you this February to Grand Cayman for the first Cayman Islands Shipping Summit, which will be exploring maritime ship finance, ship investments, and business opportunities.
There's a bit of marketing. There's a bit of marketing for you. Clay, you can talk.
I still have a microphone and I'm going to walk away with it and get a taxi cab and go downtown.
No, you can't. You see that's going to take the microphone. You're not working with me.
I still want to engage Dean Xiradakis and also Marco in discussions that I think really is very important. Marco did answer Dean Xiradakis' question in a way. What he said was, we don't have a model. And if you recall Dean's question was, how do the banks plan to finance all of these additional regulatory bells and whistles, including ballast water management equipment, all of the other nonsense that we were talking about, and which we all understand is being self-regulated, but really isn't. And this, I think, is the most important question that I've heard today, because it involves big money. And what Marco said, and I think very truthfully and very honestly, was we don't have a model. And I think the point needs to be made, the banks should have a model. The banks, the lenders, everybody, George X, George, all the other Georges except George G, should have a model, because this is the new paradigm, to use a term cliche, and that is that we're now going to have to deal with this when you finance a ship. Never mind all these wonderful PowerPoint slides that we're seeing about Panamaxes, Supermaxes, Suezmaxes, and everything else. And this is also important to say. It's not just one person in the room who's thinking this. The banks have really got to understand that what they're financing now is something quite different from what they think they're financing. And that, I think, if I may take the liberty of re-engaging Dean across here, is what I think Dean is trying to get across. Thank you.
Mr. Xiradakis, you have to speak.
Okay. I don't see why a model is required. I get
in the 80s that we were still combating with ICS systems.
crude oil washing systems. Even with changing steam engines, replacing steam engines by diesel engines. So there's always going to be challenges. Technology and innovation will never stop. I wish, actually, if there was a moment that was guaranteeing our investment, I think the world would have been full of successful ship owners. And the truth of the matter is that the world is full of unsuccessful ship owners, and the very successful are less than the less successful. So I don't think that we should be panicking. The situation is called cyclicality, technology challenges going forward, and at the end of the day, the banks will only do what the ship owners want to do. They're here to support investment decisions by ship owners and take the risk, not only on the investment, but on the name. Usually, they usually prefer to take the risk on the name first and on the assets later.
Well, the motive is there. Do we have, we do have, this is a lot of hold on, please. Zongi, Mr. Dr. Zongi would allow you to speak first.
I was not making panicking. I'm just still trying to figure out how to buy my cruise ship. I'm like,
Zongi, tell us, what are you thinking?
Yeah, I will not make a long presentation as what I did this morning, hopefully. I think what I heard from all the discussion, all debates here about models, I think that this is a long topic existing between also owners and banks, because there's, in my eyes, there are two types of owners and two types of banks. Simple. The owners are, some owners are focusing on cargo trading spot. Some owners are fixed their ships long term and secure cash flow, and then with the bank debt or equity. So this is the owner difference, mainly. And then the banks also, who are doing only private banking, and they don't care about the owner's cash flow situation on each project. They only lend to the owner who has a big fleet, who are stock listed, and who are suffering. And then the other party of the bank are doing project finance, and then more looking at the project cash flow. That's why they are more serious about each project on the long-term employment, on the cash flow. As to Yanni's question about why you pick something too central or too big name, like China Line or Grand Korea. Let's put this way, instead of the correct name. I think this is artist to choose the long-term partnership on the charters. It's not only from their name, but only from the background and the way they present their reputations. It's not only, I think, it's not a wrong way to secure long-term.
So you are telling me that someone that chosen Costco in 2007 made a big mistake?
I don't think that.
Why? What you say? Somehow like this you say?
It depends. They are different because in the harbors like Costco or China Shipping, they are non-bankrupt. But you know that.
So we are in the Greek market. Be careful what we are saying.
Yeah. But what I want to say is that actually, in my opinion, today's market is not really, because if I can say that myself as a newcomer, as shipowning side, that recently we have finalized several purchases, it always takes a long-term charter, and it's just my personal feeling to share with everyone, is that I think on each project the difficulty is not on the bank, neither the equity. But difficulty today is on each cash flow. What I can feel very apparently these days, that even last month we can find whatever modern supermarkets, modern farmers, we can find charter who can pay whatever 11, 12,000 for 5 years or 7 years. But unfortunately in this market today, even in the last 2 weeks time, there's any charter taking any ships for long term. For short term, of course, you can fix the ship for 1 year, half year, for more than 1 month, for 6, 7 thousand, you can do it, no problem. But of course, as long as a bank who consider you are big profit, you are stock rated, and that finance you can do it. But on each project basis, I emphasize on each project basis, if you do only because you are big profit, and then you get finance easily than you do without securing the long-term cash flow, then it's another matter.
I'm not interrupting you, Felipe. I'm not interrupting you. But as you are an expert in your field, allow me to tell you that even for the big listed companies, at this very moment, there is still problem, big problem. And what we are discussing here is not only for the big listed companies, it's for the small, even for the newcomers, those that want to grab the opportunity of the low side. And there is a big problem. This is something.
But if you let me finish my short finance task, is that even early this year, in March and April, there are several Greek stock listed cash bridge owner. Just take for example, what's like Diana Shipping, like Navios, they also bought several modern markets. 2005, 2004, 2006 built, because I was looking at the sector, and look at what they faced. They bought 2005 around between 20 to 21 million. Okay, was not bad early this year. And then they fixed out for 1 year or maximum 2 years faster, because I think they have their own cash flow position. They may don't need to long-term employment to get finance easily, of course, relative to lower leverage. But if you look at that time, you still have opportunity to fix even 5 years at 12,000 today. But of course, this is each owner's strategy. But today, what I'm to say today is very difficult. You can buy a Cape-size, brand new resale out of Japan or China for mid-30 million. But I think unless you are big profit, you can get the bank finance loan easily. Otherwise, it will be very difficult to generate cash flow, because it's the price of purchase not only 35 million. In the next few years, you will put more money out of your pockets.
Hold on. Before I give the podium to Philip and Nikos Stratis, you have been poisoned by Western culture. You are forgetting something that ancient Greeks and ancient Chinese culture have in common. Patience is the mother of all virtues. Be patient. Price will come off more, and charters will come back into the market. When that happens, we will buy ships at lower prices and fix them out on long or short term, whatever everybody feels. Now is the wrong time. Maybe in 2 weeks, maybe in 6 months, maybe in a year. I have no idea. But right now, you're right. Right now, if you look at the market, nothing makes sense. It's crazy. It's not cheap enough. There's no charter coverage. There's no charter active. End of story. There's no finance. Private equity is too expensive. We've got to put scrubbers in the old vessels. God knows what else we have to do. There's new regulation coming. It's all wrong. Having said that, Philip Nikos, you have something to say.
Well, the other thing I have to say is that before you finance a ship, you've got to make sure your ship makes money. So look at the return without any financing. First of all, cash for cash. I mean, if you don't have any finance, and let's say that you would finance at 6%, okay, for 65. On a cash basis, you are making 4% if you break even. So, that is probably terrible, but it's not so bad. So first find a ship where you can make 4%, and probably better, then you can look at finance. And that's the way it used to be in the old days.
I'm probably with you there all the way. Carly, before I go back to Fabrizio. No, Kathleen first. I'm sorry she's quicker than you, Fabrizio.
Thank you, darling. Just a quick question. Nikos Stratis snuck in a phrase that I haven't heard in a couple of years, and he used the word SPAC. As we all know, that is essentially how Angeliki Bangu founded her company 10 years ago. What was your intent in throwing that in, and is that a viable option for what we're discussing today?
Well, George put me on the spot and I came up with that. It's something that's been done before in a similar time. The market, well, maybe not so similar, because the market was on its way up, and he did that as well as some other people like Virtual Fast. It's a viable option, although I would say less so today than it was in 2004. I think it's not easy to raise money, equity, in this market, but certainly
excuse.
Shortly for Nikos, but before I see that, what we still continue to confuse the private equity with that. We talk about the cost of private equity. There is not cost of private equity. So there is the risk compared with the return. So Nikos, shortly. So I want to bring my members during the investment committee, because we are working in foggy weather, because there is not visibility about the future, and no cash flow to dividend or cash flow to equity are positive now, and any project are based just only on the terminal value. It's very, very difficult to explain during our committee, and for this reason, so that we stay in standby. Basically, we have to invest more than the half of our commitment, and it's very difficult to explain to several guys which attend the investment committee, and most of them are not experienced in shipping, why they have to give a positive vote on the project when the cash flow is negative, and only terminal value will justify the potential investment. So what is your approach in this moment about?
Yeah, we face similar questions, but I think for us, and when we talk about ourselves, of course, you have, apart from selecting which investments to conclude, you have equally to be very careful on selecting who your investors are. Because, of course, you might find people willing to invest in shipping and like to fish for the track record, team, consistency, history, and all this kind of stuff. But if their thinking, mentality is very different in what the industry can offer, then you're bound to run into this type of problems. So, yeah, maybe we have been educated in this process ourselves over the past 15 years, but I think the key lies to that. So it's not just sufficient to find capital that accepts what we have to offer in terms of returns. It has to be a mentality match between the business model and the industry, and the expectation and returns of preservation of capital, or whatever the model might be, at the board level.
And so that is like venture capital, because 120-150% of the net present value is composed by terminal value.
Yeah, no, it is right. We are going to change a bit the program, because this conversation has gone for a while, and it seems to be interesting. And the next session kind of ties into this. We'll just go straight to the next session, and we'll have coffee and drinks right after. I will give the chairmanship of the session over to Nikos Stratis. But I think that basically we're